Has DraftKings stock finally hit rock bottom? We'll talk about that on today's show. What is going on, investors? Hopefully you guys are doing well out there. Time to pick up the story of DraftKings, which reported their Q3 numbers yesterday, and the market hated it. The stock is down over 27% yesterday, and that's on the heels of being down over 74% over the last year. You now have got a $7 billion market cap on this one. This used to be a $45 stock. So you are looking at a company that was once worth in excess of $20 billion. We'll talk about if this is a great opportunity. I actually think we're in a market where a lot of stocks are getting tossed out. This reminds me so much of the 2008 and 2009 timeframe, where if you could make some calculated investments over that period of time, you see these gigantic exponential growth in your investments just in a short period of time. That's why we're looking at a lot of these, I would call them speculative stocks, because there's certainly opportunity if things turn around, but you need to get the right ones. And so we'll talk about DraftKings in the context of their Q3 earnings. Came out yesterday, $502 million worth of revenue. We'll jump over here to the numbers and show you that. As you can imagine, there is some things to like about this company with revenue growth just of 135% year over year. Some of that is a non-comparable business. They've added a lot of new products. Other states around the United States have legalized sports betting and gambling over the last year, and DraftKings done actually a very nice job penetrating that business where you have incumbents like MGM, Caesars, Wynn, and other more traditional gaming casino stocks. Well, DraftKings has really kind of put itself in that conversation and done a nice job rolling out to basically all the states that have legalized this type of thing. But when it comes to an investment, there are some things that Wall Street did not like, and that was the upcoming 2023 fiscal year. The company saying that they're going to have a fiscal adjusted EBITDA loss between $475 million to about $575 million on the high end. Wall Street was expecting a loss of just $426 million. So either the loss next year is going to be $50 million higher or as high as $150 million higher than what Wall Street was expecting. And when we come over here to the financials, this is not a company with a fortress balance sheet. And so it has some investors somewhat concerned with what's going on. Now, let's take a look at for the upcoming quarters. The fourth quarter, really the third and fourth quarter, are very pivotal for this company, as you have kind of the start of the NBA season, but also more importantly, you have the NFL season, but all of that kind of lines up with other sporting events like hockey and the tail end of baseball when it comes to like playoffs and the World Series. So the third and fourth quarter are really nice, and Wall Street's expecting upcoming revenues for the fourth quarter to be right at about $800 million. That would still represent over 69% growth year over year. As you head into the first and second quarter of next year, as the NFL season kind of tails off, you see a little bit of pullback in terms of their revenues, but obviously it starts to reaccelerate back into the back half of next year, where a year from now in Q4, you're expected to finally cross that $1 billion mark on that revenue side over at DraftKings. Now, clearly the revenue growth number is not what is driving the stock, because the stock has had pretty solid revenue growth for a really long time, but investors clearly haven't cared when you come over here and look at the stock chart. So let's dig into the numbers and look at what investors actually really care about. And here's that $502 million worth of revenue. Last year, you're at 212. So again, over 100% growth there. But the problem with DraftKings is it's not really a high margin business, because you see that off of $502 million worth of revenue, you had about $373 million worth of costs. That leaves you actually with very little money to spend on sales and marketing, spend on product and technology, and spend on just general administrative, running the public company. I tell you what, if you just factor in the $186 million that they spent on G&A, this company would still be at a loss. So just running the back office and all the general administrative stuff at DraftKings makes them not profitable. When you factor in product and technology, or R&D, that adds to the net loss. And then finally, sales and marketing, which is the biggest spend over at this company other than the straight cost of the revenue. Just the marketing coming in at $321 million means, yes, this company absolutely has to accelerate its revenues over $1 billion relatively quickly. And even if they do accelerate their revenues to $1 billion, which I can absolutely see that happening with DraftKings, well, your cost of revenue is going to go up quite a bit as well. So this is not your traditional kind of software play and kind of high margin business. And they don't have the advantage like an MGM and a Caesars where they can sell you on a restaurant or a hotel or some other slightly higher margin or a nightclub or drinks at their property. This is always going to be a low margin business. So they're going to have to really accelerate these revenues. And I see over the last year, they've kept their general administratives. That actually went down from 220 down to 186. Your marketing spend didn't go up nearly as much as I thought it would, from 303 million up to 321. So to drive over 100% growth on that top line, they actually didn't spend that much more on marketing. That's actually pretty impressive. And their product and technology also not a lot. So this company is starting to scale up, and the company actually did guide to potentially a EBITDA positive number by Q4 of 2023. And so that Q4 we talked about, they're going to come in over $1 billion. At that $1 billion revenue mark, yes, this company is probably going to be able to churn out a profit. The problem is that subsequent quarters where you're not going to be over $1 billion worth of revenue, I'm not exactly sure how much profit they're going to be able to squeeze out of those quarters. You flow all the way down to a net loss on this company, and it's a disaster, $450 million. Okay, when you have just $502 million worth of revenue and you lose $450 million, yeah, you better double this top line just to even get to a break-even type number. Now, one of the reasons why we're a little concerned about this company is over the last year, take a look at your cash and cash equivalents. In December, you had about $2.2 billion worth of cash, and now you're all the way down to about $1.4 billion worth of cash. That's also why I believe this stock sold off violently on the acceleration. Again, this is an adjusted EBITDA loss. This is not a general accepted accounting principle. It's not even probably an indicative of what kind of cash burn you're going to have over at this company. So this company, while I don't necessarily think that it's going to go bankrupt or something like that, it certainly would be bought out by one of the larger incumbents before something like that materialized. But this is a company that is going to have to very much manage their marketing, manage their spending, and manage their finances unless they want to do a much more dilutive round of fundraising or do the risky thing of going out to the debt markets. I would guess this company, if they had to go out and borrow money, if mortgage rates are 6-7%, this company is probably going to be borrowing money in that double-digit range. So it's not going to make sense from a shareholder perspective. I wouldn't say this company is in a great financial position, but again, it is something that they can work out as long as those revenues continue to accelerate. Now, here's the real kicker. Here's where you really understand what's going on over at DraftKings is you come down to a cash flow and you get a 9-month view on their financials, and you pull down that net loss over the last 9 months at $1.1 billion. Last year, there's actually a number very close to that. They were losing about $1.2 billion. You get to add things back in like stock-based compensation. Luckily, there's employees over at DraftKings, despite the over 70% drop on the stock, are still being compensated with shares. And look, that was to the tune of $448 million this year. Last year was closer to $500 million. All your add backs and subtractions still shows you that your net cash flow provided by DraftKings over the last 9 months is a negative $477 million. This is of straight cash. Last year, it was almost half as much, or about $200 million less, at $247 million. So our cash burn over at DraftKings has actually gotten worse over the last year on a 9-month basis. And that's not good when you don't have boatloads of cash, just $1.3 billion worth of straight cash on the balance sheet. Now, you come down to investing activities, purchases of property, plant, and equipment went from $11 million all the way up to $19 million. Cash paid for acquisitions, $96 million this year compared to $64. Okay, when your cash flows are already negative and then you burn another $20 on property, plant, and equipment, you burn another $46 on software development costs, and then you burn another $96 million on acquisitions. That comes to a total at about $172 million. You didn't really do any fundraising in the period That means over the last 9 months that DraftKings actually burned through $665 million. That's why we look at this $1.3 billion and realize that, look, if the next 9 months from a cash burn perspective go like the previous 9 months, you're going to have about half as much cash. That means this company has about 18 months of cash left on the balance sheet, and no public company would want to take it down to that last 6, 7, 8, 10 months. That's why I've always been of the belief that this company is likely going to have to somehow figure out a way to either cut costs pretty rapidly and not lose as much money and not burn through as much cash, or they're going to have to do some kind of equity fundraising or something. There are some convertible notes when you come up to the balance sheet. How these convert, when they convert, I'm sure you can dig into the 10K and figure that out. But if they're going to have to if these people are not going to want to convert to equity, well, they're going to have to figure something out there, because that's in excess of the cash on the balance sheet. We'll see what happens here, but DraftKings not looking very good from a fundamental perspective. And look, we actually talked about that 3 months ago when this company reported earnings. I did a video like, is the stock cheap enough to buy now? And the conclusion of this video was like, no, the stock is not even close to being cheap enough. Well, that was bad. The stock was like $18, $19 at that time. And so the earnings were back here in August, and the stock has just kind of sold off into channel since then. It hit a key area of resistance up here at about 18, 19. In fact, it kind of peeked its head over that and then completely fallen down. Now, from a fundamental perspective, I still have some concerns about DraftKings. I read through the conference call, and I understand that this company over the last year had to do a lot of ramping up into new states that had new gambling laws, and they had to advertise and market and do a lot of investment over the last year. So that is generating some pretty significant losses over the last 3 months, and certainly the 9 months. Some of those costs and those efforts won't lap into next year. So it's not necessarily fair to say that in the next 9 months, they're going to lose another $665 million in straight cash, but it is going to be a negative. It's not going to be a positive number. They're not going to have positive cash flow from operations or from a burn perspective over the next 9 months. So it is going to put this company into a difficult spot. But at some point, the valuation and the investors will step in on this one, and they certainly did. I mean, I can't zoom in here high enough, but the red candle of yesterday's action covers the volume. I mean, this stock had so much volume yesterday. The average volume on DraftKings is normally about 25 million shares. Yesterday, when they reported earnings, it was like 80 million shares. And so you had a huge amount of volume on this one. Obviously, some of those people are cutting ties and getting out of this one. Other people buying in. There is some support, and I wouldn't say some. There's a lot of support right here at about $10 per share. I believe this company went public like in that SPAC fashion. So it's basically round tripped all the way back to that like kind of $10 price tag. It might have been a reverse merger with DraftKings. I can't remember off the top of my head. But the point is, multiple times we're talking over 2 years, when the stock has gotten in this kind of 10, 11, even kind of like $8 to $10 range on the share price, well, the buyers have stepped in, and you've often had really significant rallies. I mean, we're talking about 50% rallies, upwards of 100% rallies. If you want to go all the way back to 2020, I mean, you went from 10 all the way up to like 70. I don't think that's going to happen anytime soon. The other thing that you have to assume is there is a floor underneath this stock, as I can imagine a competitor like an MGM, like Caesars, like Wynn, not that those companies are wildly financially healthy, but at some point I could see one of them coming in here. You also could have a Disney, which I think has a strategic investment in DraftKings. Maybe Amazon wants to get into this business. There might be another tech company that wants to get into this business. That could put a floor under this stock. I still think $7 billion, based on the fact that this company is going to have to figure something out from a fundraising perspective, probably still a little rich, but I could absolutely see from a technical perspective, if you like this one at $9, $10 per share and play a bounce, I would just encourage to take profits in these types of stocks that are on this shaky of a footing when it comes to their financials. And the company is not projecting any type of actual GAAP profits, where the company actually, after it pays all of its expenses and doesn't adjust anything out, I am not seeing any profits until Q4 of 2024. And that's just one analyst claiming that. And I can't imagine 2 years from now that they earn 38 cents per share. I just don't believe it. And even next year, when they're expected to double their revenues in Q4 to over $1 billion, Wall Street's still anticipating a loss of 25 cents per share. This is about as speculative as it gets. That's why if you play with these types of stocks, play with this type of fire, well, obviously I don't need to tell you, the volatility is high. And if you have a chance to bag some profits, I absolutely would with this one. I tell you what, just betting the sports games and playing the little daily fantasy contest actually might have been a heck of a lot more profitable than just buying DraftKings stocks. Again, over 74% decline over the last year, and just after reporting the earnings, down 27%. We've obviously gotten closer to a floor valuation on this one, and from a technical perspective, it actually looks pretty darn good here, between $8 to $9 to $10 per share. I personally like it when the fundamentals line up with the technicals. It obviously requires you to be far more patient. I wouldn't invest in this one. I think we'll cover other stocks here on the channel that are a little bit safer, but if you like risk, this one certainly will probably have a little bit of reward if it pays off. Hopefully, you guys enjoyed today's video. I'll be back again soon with more. Good luck with your investments.